So now we're actually going to complete the full worksheet with non-controlling interest. So now we have a new column here, non-controlling interest, where the non-owned portion of the subsidiary is going to see the activity flow through. All right, well, let's start off now by recording the fair value of the subsidiary and allocating the difference between the fair value and the book value to the customer base and goodwill. All right, so here we go. They purchased 90% for $1,710,000, and that was a reasonable basis for the remaining 10%. So then we can take this $1,710,000 and divide it by the 0.9 and get the fair value. So we took the $1,710,000 divided by the 0.9. So the assumed fair value of the whole subsidiary is $1,009,000, and then they give you the book value was $725,000. And so that difference has to be assigned to something, either assets whose fair value was greater than book value or to goodwill. So we've got to allocate that difference. So they tell you that there was a customer basis that wasn't recorded that had an $800,000 value. Okay, so that'll be $800,000 of it, and that difference would go to goodwill. All right, so now we can do our various entries. Let's start. All right, let's get the S entry done. All right, and then this is going to get split between the investment in and the NCI based on the percent. So 90% is going to go here, and the other 10% is going to the NCI. So that's a little bit new. Okay, and the other, line up our three debits. And verify our debits equal our credits. What did I do here? Oh, nice to have my decimal in there. There we go. Okay. And a great argument for putting the debit and credit check in there, isn't it? Okay, so there's your S entry. Let's do the A entry now. That removed the book value. Now let's step up the assets to the fair value at acquisition. So we're going to add that customer base in. And we're going to add the goodwill. And then there wasn't any others. And the same thing, we're going to credit the investment account for the 90% of those two amounts. Decimal in there this time, and then the non-controlling interest gets the other 10%. Okay, and our debits equal our credit, so we're good there. Let's put these entries in here. Okay, so there's your S and A entries. So now let's do the other three, which is the depreciation, the investment income, and the expenses. So let's get rid of the. So the depreciation is a little bit different because the the dividends. The dividends are a little bit different because some of the dividends are going to an outside party, 10% of them, and so we are going to remove the 90% here. And then the other 10% are going to get recorded here. You can do it as a difference, or you can take this times the 0.1. They are going to get credited to that non-controlling interest account. All right. Now let's do the other side, which is the investment account. Okay. Our debits debits are equal to our credits, so we're rocking along here. Okay, let's eliminate this investment income against the investment account. That's the I entry. Our debits are equaling our credits, so we're in good shape there. All right, let's amortize the customer base. They have a 10-year life. That would be $80,000 a year. And hang on a minute. We're in year 2. We bought it at the beginning of X1. This is X2. So we would have 1 year of amortization already in this account last year. So now, we would set up that initial amount less year 1's amortization. All right, so, and then we'll put this in operating expenses. Okay. All right, we don't have that problem with goodwill because we're not amortizing or depreciating that, so we didn't have to adjust the initial amount that we put up in years after year 1. All right. Okay, so a new entry that we have to do, or a new calculation we have to do, is pull out the non-controlling interest share of the consolidated income. It's actually share of the subsidiary. All right, so let's do that. So let's get the consolidated revenues. There's no adjustments here. And the consolidated expenses. All right, and this zeroes out. And so the question is, what is the non-controlling interest in net income that needs to be removed here? All right, so let's calculate that. So non-controlling interest is their original earnings minus the expense. And so the non-controlling interest would be 10% of that. So the consolidated net income then, attributable to the parent, that's going to go in the parent's retained earnings, is going to be that 437. All right, and so beginning retained earnings, this is canceled out. Net income comes from above. It's not a horizontal math. It comes from above. And then the dividends, of course, this has been eliminated, and this has been reassigned to non-controlling interest. So the only thing left is the 350. We have the vertical math here. All right. And then we can start doing the math. Okay, so this is a 3-line account here. And the NCI is also a 3-line account. So let's make a special note of that. The other accounts can use the regular math here, but not those. Okay, so let's see if this zeroes out. So we start with this, goes up by this, down by these 3, and hopefully it'll be 0. Okay, that's good. Now, the non-controlling interest is an unusual account, so you're not used to having that extra column, but it would be, we would credit these 2 here. And so these 2 credits plus a credit plus a debit up above is going to give you your ending balance here. So that's unusual. You haven't seen that worksheet worked before with the non-controlling interest. But at purchase, these 2 would set up that credit in the non-controlling interest, and it goes up using a credit for their share of the subsidiary's net income and down for their share of the subsidiary's dividends. All right, let's see if our assets equal our liabilities. Oh, we didn't pull down retained earnings from up above. There we go. Okay. Ready for the next.